All right, let's go ahead and get started. Hello and welcome everyone to this first in a two-part series on recent tax proposals from the Biden administration and congressional Democrats. Today we're going to focus on, as the first part in the series, on individual tax provisions related to capital gains and pass-through businesses. I'm your host, Will McBride, Vice President of Federal Tax and Economic Policy at the Tax Foundation. I'm joined today by Garrett Watson, Senior Policy Analyst at the Tax Foundation. Garrett will discuss the major individual tax proposals by the Biden administration and some of the proposals we're seeing from Senator Wyden and other members of Congress. Also joining us is Robert McClellan, Senior Fellow at the Urban Brookings Tax Policy Center, who will discuss some of his recent research on capital gains realizations and other aspects of capital gains, including the step up in basis proposal that both of our panelists will go into in some detail. Before we start, two housekeeping items. This webinar is being recorded and will be available on our website for later viewing. All attendees are muted, but feel free to ask questions using the Q&A button on the bottom banner. If you do ask a question, please include your name and organization when asking a question, and the panelist your question is directed to. And with that, Garrett, the floor is yours.
Thanks, Will. I want to make sure we have the slides up. If not, I can share my screen.
Here we go.
Perfect. Thank you. Thanks, everyone, for jumping on today to talk with us about the various tax proposals on the individual and pass-through side of things, both considered by the Biden administration and now in Congress. We have a lot of content to cover, and we're going to put a special focus today on the tax changes on capital gains for individual taxpayers and as well as changes to pass-through business income, though it's worth also noting at the very beginning, of course, that the president and Congress is considering pretty large changes to tax credits as well. And if we have some time, folks do have questions about those at the end, if we can get to them, we're happy to talk about those as well. So I wanted to provide here on this slide just a very big picture overview of a lot of moving parts as it relates to tax changes on individuals, primarily aimed at higher earners and high earning pass-through businesses. There's a few terms I just wanted to define for folks who haven't been following this discussion that will be helpful, I think, in both my discussion and Rob's presentation, which is starting with capital gains. Right now, long-term capital gains, those owned for over a year, if you earn a gain on an asset that you're holding, say a stock or a bond or even real estate, for example, depending on the nature of that real estate, is taxed at a preferential tax rate at a top rate of 23.8%. And you only pay that tax when you realize that gain, when you actually sell that asset. The president has proposed raising the top long-term capital gains rate for those earning over $1 million in gains at ordinary tax rates, which tops out at 43.4%. The other big change that we'll be talking about a lot to lay the groundwork on that is taxing unrealized capital gains for certain taxpayers at death. So under current law, when you have a capital gain, say in a stock, you pass away and you bequeath that to an heir, that heir has their basis or the amount that you might be taxed on adjusted to fair market value. And that means there will be no tax bill for a capital gain that a previous owner had if they're providing it to someone who's inheriting it. The president has proposed taxing those unrealized gains that otherwise would go along untaxed for those over $1 million on unrealized gains, $2 million for joint filers. There are a variety of exclusions for this proposed change, including for primary residences, and as we'll get into, potential exclusions for farms and small businesses. They're pretty important and large change that we'll be talking about a lot today. Then there are a few changes to pass-through businesses, and pass-through businesses are businesses that have their net income pass along to the owners of those businesses on their federal income tax returns. That's distinct from C corporations, which are taxed at the entity level before distributed dividends are taxed at the individual level. For pass-through businesses, there are a variety of of tax changes that you can see here at the bottom of the slide that are worth thinking about, including limiting the amount of losses that pass-through businesses can deduct from their income that was provided in the 2017 tax law, as well as extending the net investment income tax, which is a 3.8% tax on non-active income that can be provided or earned by pass-through owners, as well as other folks who often are not subject to either that tax or self-employment taxes when earning pass-through business income. And all of this is focused on higher earners, those earning over $400,000 a year. And that in turn has led to debates about how these provisions might impact both pass-through businesses and owners of capital gains. So if you want to turn to the next slide. So starting at the beginning from a high level review, it's really important to understand sort of the nature of small business in America, to understand how these pass-through provisions in particular might impact taxpayers. The census, of course, defines small businesses as having fewer than 500 employees. And that, of course, means that over 99% of businesses in the US are considered small, though they are responsible for greater than half, over 3/4 actually, of total employment. Another important point is that most businesses are indeed structured as pass-throughs, sole props, partnerships, S corporations, though an underappreciated point is some portion of small businesses as defined by census are also structured as C corps. As you can see in this chart on the slide, a little over 20%, nearly a quarter, are structured as C corps as well, which means the corporate tax changes will have some impact on small businesses if they are over the relevant income thresholds. If you want to go to the next slide, this is all important because there has been a debate and some claims about the impact that this will have on small businesses. The Treasury Department had an interesting report that argues that only 3% of small businesses will see a tax change, primarily because of that $400,000 tax pledge to prevent small businesses that earn under that amount from being impacted. There are a few more technical limitations that we could talk about on that analysis about looking at the nature of pass-through income and who is earning it. But a really important point is to understand the economic impact of a lot of these changes. We have to understand the distribution of pass-through income. And it's really the portion of pass-through income that's being impacted that will have the economic effect, not necessarily the raw number of businesses. That might be an important point as it relates to the distribution of the tax change. But from an economic perspective, the portion of income that's actually impacted is really important. And in the next slide, we actually look at the portion of income that will be impacted using IRS data. And we find that more than half of pass-through income might be impacted by these changes. And that's just a reflection of the fact that indeed a lot of pass-through income is earned by higher earners, earning over $400,000 a year. That's a feature, not a bug, of the Biden proposals, of course, for folks who are worried about combating income inequality and other related issues. But that does have the trade-off of having a larger economic impact, because a lot of that income might be subject to higher effective tax rates. More recent IRS data has looked at this issue and confirmed it as well, and something to keep in mind here. In addition to some of the evolution in the income accrued by pass-throughs over time, there's also, of course, been a larger shift from in legal status from incorporating as a C corporation toward becoming a pass-through over the last few decades. And that's a pretty big, pretty important shift, because that changes the composition of where taxes are being collected. Before, a greater portion was being collected through the corporate income tax, but increasingly so over the last 20 to 30 years, pass-through businesses have accounted for a larger fraction of total business income, and therefore a larger fraction of business income is being collected in tax through the individual income tax. And that's an important point, both for understanding pass-through's role in the tax system, as well as the total combined impact of these tax proposals on tax collections for businesses. And I think in the next slide, we actually get into that by quantifying this a bit. We use some IRS data and actually some really good data from the Tax Policy Center to try to quantify roughly the portion of pass-through revenue that has been collected as a portion of GDP over time since 1980 or so. And what we find here on this left chart near the bottom is an increase from about 0.5% of GDP around 1980 from pass-through revenue, upwards of 1%, so a rough doubling by 2015. And this is really handy because we can use that to adjust for the fact that pass-throughs are becoming an important method of incorporation for businesses, an important business form, and has an effect on where taxes are being collected. What we find is that means that overall business tax collections have remained fairly close to the historical norm since 1980, though, as many folks point out, advocates of changing corporate taxes, the corporate tax as a portion of revenue has declined a bit, including a slight decrease after the Tax Cuts and Jobs Act. But it's important to look at, of course, the total combined tax take when you're looking at these business tax changes. We then moved beyond that to look at what would the Biden proposals, including these pass-through proposals, do to business income tax collections moving forward using the CBO baseline and some historical data going way back to 1934. It's important to mention, of course, there are limitations in some of this data because the pass-through data may be much less reliable, particularly prior to the 1986 tax reform, but it still can be helpful to look at where we might land in terms of business income tax collection as a portion of GDP in historical context. And what we find is that it would generally raise it to where it was in the earlier mid-1970s, roughly gives you a sense of the order of magnitude of these combined changes. And this is including the corporate tax changes, which we'll talk about in more detail in our second Talking Tax event. If you want to move to the next slide. In addition to a lot of the pass-through changes that we just covered at a very high level, we've also looked at a lot of the uncertainties surrounding both the revenue and administrative side of capital gains taxes. This is something, of course, our fellow panelist, Rob, is an expert on and will talk about in more detail. But I just wanted to raise some of a lot of the uncertainties surrounding this, both in policy design and what it might mean for taxpayers. An important point is just taxing unrealized gains is a pretty big shift in the tax treatment of capital gains in the US. There are some analogous changes that have been made in the international context, particularly Canada's tax treatment of capital gains at death in lieu of the estate tax. But it still is a new proposal in the US. And a big question, something I've been emphasizing in a lot of my work on this, is the expectation of whether or not a policy such as taxing unrealized gains at death will remain durable, will have a big feedback effect on how much revenue we can actually expect over the long run. And that's because a big assumption here in the modeling and estimates is folks will change their behavior as to when they sell their capital gains and realize that income, pay tax on that income, because they can no longer pass along those gains to their heirs at death tax-free. There's an assumption that in economics parlance, as Rob will get into, that the elasticity, the sensitivity of those realizations will change. And that changes how much revenue you could expect when you pair this with an increase in capital gains tax rates. The tricky part is a lot of folks might think that this policy may not last, maybe repealed, say in 5 years when government control changes. And that may change how folks actually think about the policy and react. That might be very distinct from how we might expect in theory. In addition to the questions about durability and how that might impact revenue, the design of the various exemptions that might be carved out for small family-owned businesses, family farms has come up a lot, has a classic sort of trade-off that we tend to emphasize here at TF, which is that it impacts both how much revenue can be collected and creates tax avoidance opportunities for higher income folks who are looking to minimize the tax burden due to this tax change. And of course, in addition to these 2 points, it will encourage folks to pressure policymakers to provide even larger exemptions for other firms that may not be originally included. A good example of this is when you think about family-owned and operated businesses, there's a big subset of businesses that may go to close family friends or stepchildren. How do we deal with those situations if they're not considered family? And why is family the definition here of who is included or excluded from an exemption? These are the kinds of debates that will get more important as we get more details on what these exemptions may look like for small and family-owned businesses who may not otherwise have the liquidity needed to pay a tax at death. When you add all this together, just get to the bottom line here, we found that the revenue estimation, highly uncertain, but we found it might be north a bit of $200 billion over 10 years, which is a bit less than the $322 billion estimate that Treasury came out with in the Biden tax proposals. But there is, I think, a more wide than normal amount of uncertainty based on all of these question marks that will have to be resolved by policymakers. If you want to go to the next slide. This is also a helpful time to look at how the capital gains proposals will change in relation to the historical experience. One thing to look at, though it's far from the only thing it's worth noting, is the top maximum tax rate on capital gains and where it will be relative to where it's been historically. It will be the highest rate in more than 65 years, as you can see on this left chart. While effective rates are also very important in this conversation, maximum rates are also important when you're thinking about the impact on realizations and the degree of the tax change, because you can see here it's a pretty big jump up. And on the right here, you can look at, and I think as Rob will go into in more detail, there's a lot of volatility in capital gains revenue over time. That's a function both of tax changes over that time period, and of course the business cycle, which also has a separate effect on capital gains realizations. And what we found is both we want to make sure we don't overly rely on this revenue to provide funds for government services because of that volatility. And also, I think there's a good question about whether or not there is a where the ceiling is on how much revenue you could actually collect as a portion of GDP. What's striking, looking at the estate tax, for example, is how relatively flat it is. There has been a decrease a bit in the past 20 years, mostly due to increase in the exemption level and a decreasing number of estates subject to that tax. But it really wasn't significantly higher going back into the 60s and 70s, which it might be an important point to think about when you think about how much revenue we could dedicate here. If you want to move to the next slide. This just provides an international comparison of the combined top marginal long-term capital gains rate. Right now, we're slightly above the average overall, and we would go to the top under the Biden plan. Also worth noting, of course, that if we don't go to subjecting that capital gains rate at ordinary tax rates at the very top, we would be likely below both Denmark and Chile in that context. But an important point here is capital gains taxes are also assessed, of course, at the state level. So the top rate that you can actually impose has to include those state rates. And that's important to think about also in terms of looking at international comparisons as well. If you want to move to the next slide. We've done, of course, a bunch of modeling that I'm not going to get into in detail here, but I did want to point out a couple of things on the revenue side. The total combined effect of the pass-through and capital gains changes we found using our internal model is about $660 billion over 10 years. Notably, that's more than offset by the various tax credit extensions that might be considered both in the president's budget and by Ways and Means and Senate Finance. We calculated that at about $1 trillion over 10 revenue loss. And notably, of course, the two major revenue raisers here are the capital gains side at $212 billion, and then the two major pass-through changes, including extending that net investment tax to certain income that's not subject to it, and making the limitation on losses that pass-throughs can take permanent as well. If you want to move to the next slide, this gives you a sense of the economic effect. Really important to consider here. We found it's about a 0.4% decrease in long-run GDP, though notably American incomes fall a little more than that at 0.6%. And this is an important effect that's worth noting, that when you increase tax on these investments, particularly through capital gains, the after-tax return falls on American saving, but it may not do so for the saving and investment of foreign investors who may not be subject to that tax. And so what you see in our modeling, because we have a fairly open economy, the long-run change in our incomes is greater than the change in output. And that's just because that's a shift from domestic funding of those investment opportunities to a financing through foreign investors who are not subject to that tax increase. And the returns on that investment, of course, are going abroad, and that represents a decrease in American incomes of 0.3%. And of course, the big driver here being the capital gains change, and we find also major changes to the pass-through side as well, with a 0.4% decline in wages and a loss of about 64,000 full-time equivalent jobs. If you want to move to the next slide. Before turning it over to Rob, I did want to mention, of course, what we might look like, what might look like on the congressional side of things. Say if the Biden plan, as we just covered, isn't enacted, what are some alternatives that could be considered? One major one, of course, is just changing the long-term capital gains tax rate at the top, upwards to 25, 28, 30% in order to raise revenue. Notice, though, that, of course, that is not up to ordinary income tax rates. And that's because typically a lot of folks in the tax community argue that if you raise it up to 39.6% without a change in step up, you actually end up losing revenue because folks decide to hold on to their gains rather than realize those gains and pay a tax. Though, of course, some new and interesting literature has come up trying to argue that that's actually not the case. We may have a little more room there to increase the rate, but based on a lot of the historical evidence anyway, it seems like that we might be fairly limited there compared to when we remove step up. And that's how the JCT would likely look at it as well in the context of this discussion. And another thing you have to look at here is where the top bracket goes. It could remain as is, which starts at about a little north of $450,000 for single filers, or they could apply it at a higher bracket at, say, over $1 million in gains, which is more consistent with what President Biden has proposed as well. The other major thing that needs to be looked at is where exactly that exemption level for taxing unrealized gains lands. The president proposed it being at $1 million single, $2 million joint, with other exclusions or protections for small businesses and farms. We've seen Senate Finance maybe is considering a higher exemption level of $5 million or $10 million joint, which is going to have an impact on revenue. And then maybe even an additional more generous exclusion upwards of $25 million for farms and small businesses. And so where those exemptions land and what the details look like will have a big impact on revenue and administrative feasibility of that proposal. And finally, I just wanted to of course, mention that Senator Wyden on Senate Finance has introduced a suite of tax proposals that we've been looking at closely, including trying to pilot his mark-to-market ideas by taxing certain financial services products on a mark-to-market basis, including derivatives and carried interest, taxing those at ordinary income tax rates rather than the preferred capital gains rates, looking at maybe restricting IRA contributions for higher earners. This is coming out of a lot of the reporting that several very high net worth individuals have very large Roth IRA balances due to contributing startup stock, for example, into IRAs. And finally, of course, we have to mention potential changes to the Section 199A pass-through reduction, which provides a upwards of 20% deduction on qualified business income for pass-throughs. Senator Wyden is looking to restrict that deduction for those earning over $400,000 a year, as well as limiting or removing some of those limitations for those earning less than $400,000. And we can get into these in more detail if folks have questions at the end, because there's a lot there and they could be very much in play. I think that's it. So I'm going to turn it over to my colleague, Rob, to go more detail on his excellent research on capital gains.
Thanks, Garrett. And I wanted to thank the Tax Foundation for this opportunity to talk today about capital gains and how they might be affected by tax increases being proposed by the administration. As we heard, the administration is proposing to tax capital gains realizations like ordinary income, that is, like wages and salaries, but only for those with more than $1 million in income. That's not many people. Had the proposal become law in 2018, only those at the top 0.3% of the income distribution would have been subject to the new rate. Now, this doesn't mean that only a small share of capital gains would have been subjected to it. Those taxpayers with incomes greater than $1 million realize more than 60% of all capital gains. In other words, a majority of capital gains could be subject to this tax, even though only the top 0.3% of taxpayers will be affected. Of course, saying that the 60% of gains would have been subjected to the tax doesn't mean that the tax would actually be applied to 60% of gains. It wouldn't, because taxpayers would adjust their behavior in the face of such a large tax increase. I think that the responses would fall into two general categories. First, many taxpayers might be able to make relatively small changes and escape the tax increase. This could happen because many of those millionaires aren't that far over the line. About 40% had incomes between $1 million and $1.5 million. So it might be possible that a large number of these taxpayers could have their income slip under $1 million just by adjusting their income. For example, they might be able to receive a bonus over 2 years rather than 1. And that doesn't mean that most gains would escape taxation. Of those gains realized by millionaires, more than 90% were realized by those with incomes greater than $1.5 million. More than 2/3 were realized by those with incomes greater than $5 million. Now, there's nothing special about $1.5 million or $5 million. I use them because they're the breakpoints available in public data. Nevertheless, these numbers make it clear that most of the gains by millionaires are being realized by taxpayers with incomes well above $1 million. Now, we can also get at this question by asking how many people are millionaires just because of their capital gains? And how often are people millionaires? A 2010 Tax Foundation report by Robert Carroll attempted to answer these questions. He analyzed the taxpayers over the 1999 to 2007 time period and counted the number of times they made at least $1 million and the number of times they made at least $1 million without including capital gains. And what he found was that being a repeat millionaire is relatively rare. About half of those taxpayers were millionaires only once during the 9-year period. Long-term millionaires, on the other hand, were relatively rare. Carroll found that only about 5% were millionaires across all 9 years. Overall, he found that just over 1/3 were millionaires because of their capital gains realizations. And he found that about half of these one-off millionaires made that much because of their capital gains. Some of these taxpayers undoubtedly could stay under the $1 million level by spreading their realizations over several years. For gains from the sale of liquid assets, such as stock, this would be relatively easy to do for those incomes that are not far over $1 million. Can we see my slides, please? Just 1 second, we'll get my slides going. Okay, can we go to the next slide? Thank you. So for example, consider a taxpayer with $700,000 of income from sources other than capital gains and $600,000 in unrealized gains held in stock. If the taxpayer sold all their stock in 1 year, their income would be $1.3 million and $300,000 of capital gains will be subject to the higher rate. But suppose they sold half the stock in each of 2 consecutive years. Then their income would be $1 million in each year, and none of the capital gains would face the higher tax rate. The Wall Street Journal recently ran an article that gives us another example. That article focuses on an apartment owner who pays himself $75,000 a year, but hoped to sell a complex for more than $1 million to fund his retirement. Could an apartment owner similarly structure a contract to sell it over several years? I'm not a lawyer, but possibly. The second category of responses is more of a long-run response by taxpayers who can't easily avoid the tax increase by lowering their income. Can I see the next slide? Thank you. So we have 2 types of studies that can be used in predicting what happens if taxes will be raised, and I'm going to describe the research I've conducted in each of these types. In the box here, I've divided tax changes into small tax changes and large tax changes, and I've also divided the length of time assets are held before sale into possibly more than 2 years and less than 2 years. Now, there is research studying small tax changes on assets held for any duration before sale. That's the upper left-hand box. And there is research studying large tax changes on assets held for less than 2 years. That's the lower right-hand box. But what we don't have is a study in the upper right-hand box on the effect of large tax changes on long-held assets. And that's a problem because that's the type of tax change being proposed by the administration. So I'm going to show you one set of results, and then I'll show you the other set of results, and I'll squint a bit at that box where the proposals are sitting and try to describe how the sale of long-held assets might change in response to a large tax increase. Before I start, I have to introduce one economic concept, elasticities. In our case here, we'd like to know the percent change in capital gains from a 1% change in taxes. We expect the elasticity to be negative because increasing tax rates should decrease capital gains realizations. As an example, if capital gains have an elasticity of -0.5, then a 10% increase in tax rates, such as an increase from 20% to 22%, would lead to a 5% decrease in realizations. An elasticity of -0.3 would lead to a 3% decrease. Needless to say, larger elasticities mean that for any given tax increase, realizations decline more and the potential revenue increase gets smaller. So the larger the elasticity in absolute value, the less revenue we raise by raising taxes. I wrote the first study while I worked at the Congressional Budget Office, along with a CBO colleague and a colleague working for the Joint Committee on Taxation. To improve the modeling of how capital gains respond to taxes, we used data derived from tax returns. We were able to observe capital gains realizations from 1999 through 2008. Can you see the next slide? Thank you. We did not limit ourselves as to how long these assets were held, so some of them were undoubtedly held for many years. And we also observed changes in tax rates. The total tax rate on capital gains is the federal rate plus the state and local tax rate. Unlike the federal government, states mostly tax capital gains like ordinary income, such as wages and salaries. And more importantly, state tax rates tend to change relatively frequently. In the figure here, we see the combined federal and state tax rate for 4 states. At the bottom of the figure is Florida, which has no income tax. So the combined federal and state rate is therefore just the federal rate. And as we can see, the rate basically remains unchanged except for a tax cut in 2003. Towards the top are three other states, California, New York, and Rhode Island. At the beginning in 1999, California had the highest combined rates, followed by New York and the Rhode Island. Over time, these rates changed. Some combined rates that went up, others went down. And by 2004, California was again at the top, Rhode Island was in the middle, and New York at the bottom. Now, notice while all these changes were frequent, the changes were relatively small. The big change was at the federal level. When we compared realizations to changes in combined state and federal rates, we concluded that the elasticity of capital gains realizations was about minus 0.7. Now, this didn't apply to just millionaires, but to all taxpayers realizing capital gains. If the realizations of millionaires are this responsive, we would expect that a large share of potential revenue gain from the proposed tax increase would be lost. The second study was completed while I was at the Tax Policy Center. Next slide, please. Again, with a colleague from the Joint Committee on Taxation. And this study analyzed data for just 1 year, 2012, and only for assets held for less than 2 years before they were sold. We used such a short holding period so that we could focus on that 1 year mark. As Garrett mentioned, assets held for less than a year before being sold are considered to be short-term gains, and they are taxed like ordinary income. Assets held for more than a year are considered to be long-term gains, and so they're taxed at a lower rate. And notice for millionaires, the administration is, in essence, proposing to tax long-term gains the way short-term gains are taxed here, including the 43.4% top tax rate then in effect. Now, this figure gives us some insight about how realizations could change. It charts average realizations for the weeks leading up to that 1 year mark and the average realizations afterwards. So for the weeks leading up to that 1 year mark, average realized gains are just over $600 per transaction. But as soon as the lower tax rate applies after the first years, gains jump to nearly $1,200 per transaction. Now, even though there's more week-to-week variation past that 1 year mark, you can see more squiggles, the pattern is clear. High tax rates are associated with low levels of gains, while low tax rates are associated with high levels of gains. Translated to an elasticity, we get about minus 0.8. Now, it's obviously quite similar to the minus 0.7 found in the earlier paper. So small tax changes on possibly long-held assets result in an elasticity of about minus 0.7, and large tax changes on assets held for less than 2 years result in an elasticity of minus 0.8. So we can kind of have some confidence that gains on long-held assets will respond to a large tax change with an elasticity of about minus 0.7 or minus 0.8. Now, as with the prior estimate, this doesn't apply to millionaires, but with this study, we're not totally out of luck. Can you see the next slide? In the same research, we plotted total realizations relative to the last week's realizations after tax. Relative to the last week realizations are taxed at the short-term rates. In other words, gains are set to 1 the week before tax rate drops. That means that the very next week, if gains go up if gains are 1.5, that means gains increase by 50%. If gains are 1.7 in that week when the rates dropped, then gains increase by 70%. We also broke out these realizations by the adjusted gross income of the investor. And what we see is that the realizations for those with incomes below $1 million doubled the first week that the long-term rate applied. That's a big increase. That means people in those income brackets are very responsive. But gains by those with at least $1 million of income shot up by a factor of 7. This indicates that millionaires, or their financial advisors at least, are very well aware of the change in tax rates, and they respond accordingly. If the millionaires were to respond to an increase in taxes with this same intensity, the elasticity might be much higher than minus 0.7 or minus 0.8, and even fewer revenues will be generated by raising the tax rates. So what are investors going to do with the assets if they don't sell them? Garrett already talked about this a bit. And the common belief is that they'll simply hold on to them, possibly for the rest of their lives. The reason for this is as follows. The purchase price of a capital asset, including transaction fees, plus the cost of improvements to physical capital, if there is any, is known as the basis of a capital asset. A capital gain is the amount by which the sale price of a capital asset exceeds its basis. Under current law, when an investor dies and passes capital assets on to their heirs, the basis is reset to the current value of the asset. That means if an heir immediately sells it, no capital gains taxes are due. This increase is known as the step up in basis, and it gives investors an incentive to hold on to assets until death. This step up in basis also makes possible the buy, borrow, die strategy that has recently appeared in the news. In essence, one purchases an asset, and when money is needed, rather than sell the asset, borrow the money using unrealized capital gains as collateral. Once the assets are passed on to heirs, the basis is stepped up, and if the heirs want to, they can immediately sell the asset without owing any capital gains taxes. They can then use the proceeds to pay off the loan, including interest, and keep the remainder. And it is for this reason that the administration has proposed to tax unrealized gains at death, with $1 million exemption for singles and an extra $250,000 for principal residences. For married couples, the exemption will be $2 million with $500,000 for principal residences. In other words, unrealized gains will be deemed to be realized on the final individual tax form. Some people compare this to an estate tax, and it's a bit like an estate tax, but there are a few differences. First, an estate tax is based on the total value of the asset, not just unrealized gains. And second, the exemption level is $11.7 million, and double that for married couples. The exemption for taxing realized gains at death is quite a bit lower than that one for the estate tax, obviously. But the estate tax exemption has increased dramatically over the years. In the year 2000, that exemption amount was $675,000, which, after adjusting for inflation, is about $1 million now. So the exemption rate being proposed on unrealized capital gains at death is about where the exemption rate was for the estate tax back in the year 2000. Although more taxpayers will be subject to this tax on unrealized gains at death than are currently subject to the estate tax, only a very small share of estates would owe any taxes. Using the 2019 survey of consumer finances, I calculated that only about 3% of households had unrealized capital gains of $1 million or more. Limiting the analysis to those who are at least 70 years of age, and I found it was between 2 and 3% would be affected. If the main alternative to paying capital gains taxes is buy, borrow, die, it's difficult to imagine how this couldn't reduce the response of capital gains to tax increases somewhat. I understand Garrett's points that there will be opportunities for tax avoidance, but it's hard to see how there wouldn't be at least some effect, and the elasticity would fall somewhat. So summarize all the points I've made. The administration is proposing to sharply raise capital gains taxes on millionaires by treating those taxes the way short-term gains are treated. Recent research shows that capital gains realizations are quite responsive to changes in tax rates. There's reasons to believe that realizations by millionaires would be even more responsive. To prevent millionaires from not realizing gains and holding them until death, the administration is also proposing to tax unrealized gains at death. This would affect perhaps 3% of households, but would likely increase the revenue generated by raising the rate on millionaires while they're alive. And thank you, that's what I have.
Great. Thank you very much, Rob and Garrett. Very interesting stuff there. A lot to take in, unless you're completely steeped in it like we are. That's an intense amount of information. Wanted to point out that Rob, you've got the best location here among us. You're dialing in from Paris, as I understand it, and I was trying to pick out the capital gains tax rate in France from Garrett's chart. So that's maybe a question for Garrett. If you can pick that out for us and let us know in the next round of questions. But Rob, I'm wondering, on your capital gains research, what in general, what can we learn from these the past, the recent history of capital gains tax rate changes and other changes to the brackets and what have you, and how applicable is your research over different episodes to the current situation, and in particular, what factors matter for capital gains realizations? Is it the business cycle and things like the amount of unrealized gains that are out there with the current stock market being where it is? I imagine it's quite high. Other factors that may have changed from the past, the different changes in state level capital gains taxes, And then, finally, what is your, you discussed the millionaire threshold and how they appear to be more sensitive than other, those earning less than a million in income to changes in capital gains tax rates. What is your guess, if you choose to venture a guess on the revenue maximizing rate for that bracket for those earning more than a million? What is the revenue maximizing rate on capital gains?
Wow, that last one is a real difficult question. So I'll go back to the earlier questions. So I think what we can learn from the past research is that there are capital gains realizations are quite responsive to tax rates. There's been several recent pieces of research that indicate that it might be lower. I think those are important pieces of research, but I don't think they're definitive. So from my point of view, I still believe that capital gains elasticities are what we found on the order of -0.7, -0.8, something along that lines. And it seems to hold whether tax rate changes are small or tax rate changes are large. And so I guess we can infer that long held assets held for 10, 15, 20 years would respond to large tax cuts the way we've seen elsewhere. Elasticity -0.7, -0.8. Small tax changes are going to be, smaller tax changes by states are also going to be important. How important? Well, as we saw in that chart, we see when the federal government makes a change, it tends to be a much larger change than the state tax changes. So I would say this increase by the federal government, were it to occur, would dominate any small changes by state tax rate, by states. You said something important about the amount of unrealized gains. I think that's a relatively unrealized point. And I think it needs a lot more research. It's something that I've been thinking about doing. I think it's very important. This cloud of unrealized gains getting larger and smaller has to have some effect on how many gains are realized when a tax rate changes. But we don't have any real good handle on how the relative size of this cloud of unrealized gains matters. So in terms of the this $1 million threshold, a lot of people might be able to avoid this entirely by, as I've indicated, by restructuring their incomes, by not realizing gains in 1 year, by realizing over 2 or 3. I wish we had a good handle on how many could do exactly that, who could stretch gains out over 2, 3, maybe even 4 years and stay under the threshold. It probably wouldn't have much of an effect on the tax revenue, because I think, as I said, most of the capital gains are being realized for people who are well north of $1.5 million or $5 million. You asked me about the revenue maximizing rate for millionaires. Golly, that's it's probably lower than the revenue maximizing rate overall, because I believe that millionaires do appear to be more responsive, or the capital gains realizations of millionaires does appear to be more responsive than overall capital gains realizations. So it's probably lower than it is for the overall rate. How much lower? I really don't know. We need to get some research on this. So it's a great point, and unfortunately, I don't have a definitive answer.
Okay, great. Following up on that, more on capital gains. There's a lot in these proposals. We have some questions that have been raised about the implementation of it, and particularly how would gifts be treated under the proposals, the Biden administration proposal, for instance, and how workable is that? How is that? Has that been? There's certainly the estate and gift tax in the current law. And so what can we learn about the estate tax and the gift tax in relation to the current proposal? If you could take that, Rob, and Garrett, you can take a swing at that if you want as well.
Sure. So yeah, implementation is going to be critical in this for sure. And I think I don't know anything about the specifics about how gifts would be handled, for example, but it's clear that the specifics of this proposal are going to matter a lot. Like Garrett indicated, there will be more opportunities for tax avoidance. And if we see a behavior relative to taxing unrealized capital gains at death, as we see at estate taxes, we'll see quite a bit of a behavior, quite a bit of opportunities to work on tax avoidance. I know some people believe this time is different. This time we'll plug all the leaks, and I'm just skeptical. I can't skeptical that's going to happen.
Yeah, I think I would just add that yeah, details like about how gifts will be treated are going to be pretty important. Of course, there is of course analogous protections in the estate tax where if you have a gift in excess of the amount that triggers gift tax, you can apply effectively a tax credit that draws down some of your estate tax exemption. You might be able to see something like that that's analogous on the capital gains side to ensure that more obvious opportunity for avoidance is closed. But as Rob just said, it'll take a lot more work, particularly as it relates, of course, to trusts. We're seeing a lot of discussion about GRATs and other vehicles that have been used to try to avoid the estate tax in the past. That the Biden proposals to the Treasury have tried to preempt a bit of that by trying to provide some of that detail, but more will be needed as folks see this as a more salient and possible likely proposal being considered to close the various gaps. But it's going to be very hard to do so in anticipation. We'll have to see how the planning industry evolves to adapt to that new environment if it does take hold.
Great. Okay. A little more on the implementation of the capital gains proposals. Question about when this might be put into effect. Capital gains changes in the past have varied on that. So it's certainly uncertain. But if both of you could comment on when these policies might become effective.
I don't have a lot of insight on that, except to say that if they don't make it a retrospective tax, then a lot of revenues will be lost by people rushing forward to realize gains. This is exactly what happened in the Tax Relief Act of 1986. There was a lot of gains realized once people realized the rates were going to go up.
Yeah, I agreed. I think that's right. And we're seeing some of that in the Treasury proposal in the Green Book. They were recommending a date of announcement date that's effective for a lot of this. We'll have to see. A critical point will be, I think, in markup and release of a lot of the offsets in reconciliation, both in Ways and Means and Senate Finance, to see if they go the similar direction, which they could, if they decide to do a date of announcement type enactment, could be mid-September if it does show up there. Another key part of this is whether or not they go with a more incremental increase in the tax rate, which still could trigger folks trying to realize ahead of time, but maybe less so than a more dramatic increase. So part of that might play into as to whether or not that retrospective application is seen as prudent, given that concern.
Okay, just one more question about capital gains, and this has to do with an alternative approach to repeal of step up in basis and taxation at death of unrealized capital gains. Something that has been tried in the past, at least for a time, and carryover in basis as an alternative approach there. I think in the late 70s, this was for a time it was on the books, but I think it wasn't fully effective as I understand it. But Rob and Garrett, then if you could comment on that.
Sure. First, a really tiny technical point. Step up in basis isn't being repealed. All that's being added is capital realizations at death. The step up in basis would still, in fact, occur. The alternative carryover basis, that was tried briefly, was never enacted. I guess the difficulty is tracing back what happens to an asset with the basis of an asset purchased many generations ago. That doesn't seem like an insurmountable difficulty. It seems like there should be some way to get that to work out, especially now most assets for stocks and other financial assets are recorded electronically. So there should be an electronic record going back several decades at this point. I think that's about all I have. I've got one more point, but I've forgotten it, unfortunately.
Okay, well, let's move on with the time we have and talk a bit about the pass-through business proposals. And Garrett, you certainly touched on many of the issues there, but Garrett, what is if you could tell us a little bit more about how the pass-through business sector has changed over the last few decades, and what that means for these proposals, as far as how impactful they may be, how many taxpayers would be affected, how many workers are potentially affected by these pass-through business taxes.
Right. Yeah. So I think as I highlighted at the beginning, small businesses, which are disproportionately pass-throughs, do make up something like 3/4 of all of total employment. So it is a pretty significant chunk of the U.S. economy that has to be considered when you're thinking about these tax changes. I think an important point that we didn't cover in detail earlier is there's a lot of attention paid in the Tax Cuts and Jobs Act discussion and elsewhere about the tax differential between C corporations and pass-throughs. And one of the reasons why there was so much work done on the pass-through deduction, as imperfect as it might be, was to ensure that when you look at the combined effective tax rate between corporations, C corporations that have an entity level tax and taxes at the individual level, and one layer of tax at the pass-through level, is to ensure that at a higher rate, the ordinary income tax rates, is to ensure that effective tax rate is within striking distance, because otherwise you have incentives to move between entity types. It's a lot of energy being done to do that. And of course, tax is only one of many reasons why you pick a particular entity type. But if the differential is too large, that does cause many distortions in the tax code and economic activity. And so the reverse of that happens here. If you are, and as we'll get into in the next session, when you start increasing tax rates on C corporations, there may be that differential in reverse, which then, of course, encourages potential tax increases on pass-throughs, which for folks who think those tax increases are not the right choice right now, sort of magnifies the overall effect. But that is something else we'll have to watch closely when you look at not just the rates, but also all the various changes to, say, the loss limitation question, the question of applying net investment income tax to active pass-through income that hasn't been taxed through the payroll tax. Questions like that, like trying to see what that effective tax rate will be, is going to be really important, because that's not only going to impact the economic activity side, but also which entity type folks choose in the long run, which, as we saw after the reforms of the 1980s, was part of the reason why we saw such a shift in the pass-through sector afterward.
Great, thank you. All right, couple minutes left. Garrett, you covered many of the proposals there and touched on the carried interest proposal. If you could go into that a little more detail, what is carried interest, and why is it subject to under current law a lower rate of tax than ordinary income? And what is the proposal? What are the proposals out there from the Biden administration and from Senator Wyden? My understanding is Senator Wyden is proposing a mark-to-market approach for taxing carried interest, in addition to taxing it as ordinary income. You can just go into that a little bit for us.
Yeah, I'll try to provide the Cliff Notes version here. So basically, investment managers at private equity firms, hedge funds, are often have slightly different compensation arrangements than ordinary workers who get paid straight wages. So, for example, if they make an investment, they may be compensated by the well-known 2 and 20 arrangement, which is 2% of all the assets invested and 20% of the additional profits they bring in. That 20% amount is often known as carried interest. And the big debate here at the 30,000-foot level is how should that carried interest be taxed? Should it be taxed closer to as a form of capital income that should be taxed potentially at that longer term capital gains rate? Tax Cuts and Jobs Act requires it to be held for 2 years before it can be treated that way. Or as folks like Senator Wyden argue, is it closer to labor income that's being accrued to these managers and should therefore be taxed at ordinary income tax rates. So a lot of this has to do with that deeper discussion of the difference in how we tax capital income and labor income, and the trade-offs surrounding that. And an unfortunate byproduct of that is we now have to have more esoteric discussions about the nature of labor and capital income and what that means for these particular more niche issues. That's sort of what's going on in that debate. Of course, it's not a large revenue raiser as it relates to other provisions. So this really isn't a revenue question. It's more a question of, is there, a tax equity issue here? Is this disguised labor income? That's a lot of the discussions that folks are having on the pass-through side or folks taking capital gains is how we delineate between capital and labor income, which in our view might be resolved through just simplifying the code a bit and uniting and integrating the code, which might help avoid this discussion entirely.
Great. Any last comments on that topic, Rob?
No, I think you did a good job describing, and especially having to get into the esoteric conversations about how to parse capital and wage income. So, yeah. Great.
Well, thank you both. This has been excellent. It's been detailed and it's a lot to take in. So we will have, as mentioned at the beginning, the copy of this recording available on our website for future reference. And you know where to reach our panelists. They are public intellectuals. So we really appreciate it. And don't forget to sign up, register for next week's event on the corporate tax proposals that the Biden administration has put forth, and any other congressional proposals related to corporate tax that may come up between now and then. So that event is next Friday at noon. That's the 17th. And with that, I will sign off and thank you all for attending. Bye-bye.